Bonus issue and impact on wealth. Bonus issue and impact on wealth. See here, in this segment, we are going to understand. Sir, again, we came to concept. Chop shop approach, all these are bacha concepts. Budget announcement, all these questions are normal questions only. Nothing great concept involved. Just you need to understand how to do them. Since they are there in the study material, I am forced to do. No great concept involved in that. And that too, chop shop approach institute answer is not as per the standard of what the real chop shop approach wanted to convey. So, okay, leave it. Let us come to the main issues of this chapter. Bonus issue, buyback, rights issue. These are the three concepts we are going to discuss now. First one is a bonus. Simple concept. Whenever company is having the profits, company has two options. One, declare dividend. Two, go for a bonus issue. Bonus issue, another name is also there, which is called as a stock dividend. Which is called as a stock dividend. Whenever bonus issue questions are given, okay, first you need to understand one point. Whenever bonus issue is made, the return to the shareholder will increase. Reason is, without investment, market value will increase. For example, a share price is 1000. I have one share or I have 10 shares. They issued, say for example, 1:5. Means for every 5 shares, one share I will give. For my 10 shares, I will get 2 shares. Means 2 shares, I already have one share, 1000. 2 shares came again. Again 2000 increase. So totally my wealth became 3000 with no extra investment. Whenever the return is increasing without investment, automatically the return will grow as a percentage. So one thing is very clear. Bonus issue whenever made, it will impact the wealth or not. It will necessarily impact the wealth. What will happen? It will rise. The KE will, listening or not, the return to the shareholder will increase because instead of paying the dividend in cash, they are paying the dividend in the form of bonus shares. Clear? Number one. Number two, whenever question is given on bonus, the most important thing is you need to understand the bonus ratio, because bonus shares are not given upfront. Bonus shares are always given on a proportionate basis. Means 1:5, 2:3, like that they will announce. Means it will be always on a ratio basis. It will not always on a bulk basis. I will give you 1000, I will give you 2000, like that it will not be. It will be on the basis of what? It will be on the basis of the calculations on proportionate basis. Number three, whenever bonus shares are made, whenever bonus shares are issued, purchase number of shares, sale number of shares, both will not be same. For example, I wanted to hold a share today, hold it for 7 years and sell. Okay, fourth year the bonus is issued. Okay, first year no bonus, second year no bonus, third year no bonus, fourth year no bonus, fifth, sixth, seventh ki bonus shares are also there. Seventh year when I am trying to sell the share, I will not sell the shares, I will sell my shares originally bought plus the bonus shares which were issued free of cost. So sale consideration will magnify because without additional investment you got extra number of shares there. Understood? Is the next segment of discussion. On this footing, we are having two questions. Two buyback bonus issue questions are two different types of questions. Means you will learn two different concepts there. Let us understand what is the question. Take question number 21. Take question number 21. Take question number 21. Mr. X purchased 100 shares of A Limited on 1495 at a market price of 30. On 1499, the company made a bonus issue of 2:5. He sold the shares. He sold the shares on 31/3/2001 at a market price of 50 come dividend. He had to pay tax at the rate of 20% on his dividend income and 15% on the capital gains. If the company pays a regular dividend at the rate of 10%, find out whether investor X was able to earn his required return of 10% on his investment. Read the question. Okay, read the question. Let us read. Mr. X purchased 100 shares of A Limited on 1495 at a market price of 30. Okay. On 1499, company made a bonus issue. 1499, company made a bonus issue of 2:5. He sold these shares on 31/3/2001 at a market price of 50. Okay, come dividend. He had to pay tax at the rate of 20% on his dividend income, 15% on the capital gains. If company pays a regular dividend of 10%, find out whether investor X was able to earn his required rate of return of 10% on his investments. This is a question that is being asked. First of all, everyone tell me, shall we start doing the answer? Nothing great here, just we need to solve this question, that's it. Nothing great. Bonus issue came, number of shares will increase, value the wealth. That's what he's asking. Shall we? Everyone reply. Then we'll begin. Okay. So see here. Mr. X had purchased 100 shares of A Limited on 1495 at a market price of 30. On 1499, company made a bonus issue of 2:5. He sold these shares on 31/3/2001 at a market price of 50. Come dividend. Okay. Let's have the schedule first. Keep the heading. Question number 21. It's a very old question, but a very good question. After that, they didn't test. If new point on bonus has to be discussed in the exam, this will be the question. Okay. First, write down step 1. Step 1. 1 second, listen. Okay. Write down. Cost of acquisition. Cost of acquisition. Okay. 3000. Step 2. Step 2. Number of bonus shares and total shares. Number of bonus shares and total shares. So see here. Number of bonus shares and total shares. 100 shares are there. Bonus issue is 2:5. Right on there. Forty. Total shares is 140. So number of bonus shares and total shares 100, 2:5, 40 and 140. First of all, everyone answer up to here. Everyone had a clarity. Like this step by step, if you do, you will not commit mistakes in exam. Up to here, understood clearly. Next. Step 3. Calculation of value of the holding. Okay, calculation of value of the holding. Okay, write down clearly. Here, dividend, tax, post-tax dividend, PVCF. Here, properly write down 1995 he bought the shares at rupees 30. Okay, he will not get the dividend in 95, he will get the dividend in 96. So 96 onwards we need to do. Okay, these are the number of years: 96, 97, 98, 99, 2000 and 2001. Okay, these are the various years that we need to consider. Next, dividend. Dividend is declared at what rate? Dividend is, he had to pay dividend tax. He had to pay tax at the rate of 20% on his dividend income. How much is the dividend that is declared? Regular dividend of 10%. Okay, and 15% on capital gains on the 20% taxation. Dividend at the rate of 10%. Tell me, how many shares we purchased? 100 into par value is how much? Market value is 30. So par value will be assumed as 10 into how much is the dividend that they declared? 10%. So 100 into 10 into 10%. Okay. 1000 into 10% means 100. Right now. 100, 100, 100, 100. But 2000 and 2001, it will change. Why it will change? Reason is, in the year 2000, bonus issue is made. Therefore, I will get dividend. I will get dividend not on 100 shares. I will get dividend on 140 shares. So 140 into 10 into 10%. 140 rupees. Okay. Next, 2001. 2001, I will sell the share at how much? 50. Okay, I will sell the share at 50. Like we saw in the time horizon questions, na, I will hold it for 5 years. After 5 years, so I will get the dividend for first year, second year, third year, fourth year, fifth year. After receiving the dividend, I will sell the share. Therefore, while selling, you are selling a ex dividend share. But in this question, point was different. He said come dividend, means again in the year 2001 you will not get any dividend. Okay, in this 50, dividend is already inclusive. So therefore, for 2001 we will make the calculation. Okay, before that, put a star mark here, put a star mark here, give some 3-4 lines space and write down there 1 or 2. Okay, star 1, 100 shares, rupees 10 par into dividend rate, rupees 100. 140 shares, rupees 10 into dividend rate, 140. First of all, everyone answer up to here, understood or not? Reply, or else we can't continue. Reply everyone, understood or not? Okay, yeah. Next, whenever dividend is paid, there is a tax also on that, because there is a dividend tax. Okay, at the rate of how much percent here? Dividend tax at the rate of how much percent? 20% taxation is there. Okay, reduce that. Okay, minus 20, minus 20, minus 20, minus 20, and minus 28. Okay, so these are the various tax rates, tax amounts. Okay, 2001 year, 2001 year, 2001 year, there is an adjustment. Write down 3. Okay, write down. Net sale consideration, underline. Net sale consideration, underline. See here, purchase sale consideration equal to 140 shares. See, 15%, sorry, he has made sale of 140 shares at 50 rupees each. 140 into 50. 140 into 50. Write down everyone. 140 into 50. 7,000. Purchase consideration. 100 shares of rupees 30 each. Already we have done. 3,000. 3,000. Capital gain. 4,000. Tax on capital gain. 4,000 into 15%. 600. So what is the net? 3,400. If you write that, answer wrong. We are not doing income tax. Net capital gain we are not calculating. We are calculating net sale consideration. If you do 4,000 minus 600, 3,400, and they gone. From there your answer blast on your face. Reason, income tax lo we want capital gain calculation. FM lo we want the net sale consideration calculation. In this 700 sale, I will not get entire 700. 600 will be going out in the form of taxation. That's what we want here. Hey, everyone, answer. Answer. Did you understand what I said? Don't make mistakes in exam. Did you understand what I said? So therefore, see here, write down here. 7,000 is the value. In that 7,000, taxation will be gone by 600. Okay. So 100 shares of 10 rupees each. We got the dividend 140 and net sale consideration tax on capital gain is 600. So 7,000 is the realization, 600 is the taxation, 6,400 is the net realization that I have got. Okay. Sir, then where you consider 3,000? Wait, we will show where you will consider. 3,000 is what you invested today. These are all future cash flows. Second column is about future cash flows. 3,000 is investment today. Investment should be reduced from the present value factors what we get. 10%. 1 divided by 1.1. Write down everyone. 0.909. 0.826. 0.751. 0.683. 0.621. 0.564. What is the value of holding? What is the cost of acquisition? What is the NPV of holding? Value of holding. Do it. 80 into 0.909. 80 into 0.909. 80 into 0.826. 80 into 0.751. 80 into 0.683. 112 into 0.621. 6,400 into 0.564. Rupees 932.67. Rupees 932.67. Rupees 932.67. So this is the answer. Everyone understood the calculation clearly? Not just doing it. Did you understand every point, whatever we have done? Understood the calculations and the psychology behind the question? Everyone answer. Don't sit idly. Everyone answer. Understood up to here clearly? Okay. Done. Everyone answer. I'm asking you people. Understood the question clearly? Understood this answer, the way in which we have done everything, all the steps. So, to sum up everything, in this question, what is the new point that we learned? Dividend has the taxation in all the levels. Capital gain tax should be reduced from the sale consideration. Okay. Bonus issue is made in the beginning of 99. Therefore, for the 99, dividends will not be paid on bonus shares. And share is sold come dividends. So many new concepts that are there in this particular question. Everyone understood? Let us move on to next question on bonus issue. Question number 21 completed at 22. This is a study material question, RTP, MTP, very popular. This one, 22. Mr. A is thinking of buying shares at 500 each, having a face value of 100. He is expecting a bonus in the ratio of 1:5 during the 4th year. Annual expected dividend is 20%. Dividend rate is expected to be maintained on the expanded capital base. The shareholder intends to sell the share at the end of 7th year, expected price of which is 900 each. Incidental expenses at the time of purchase and sale are estimated at 5% on market price. He expects a minimum return of 12%. Minimum expectation of, so incidental expenses at the time of purchase and sale 5%. He expects a minimum return of 12% per annum. Should Mr. A buy the share? What is the maximum price he can pay for the share? Assume no tax on dividend and capital gain. So taxation impact is not there in the question. Okay. Read the question first before we go with the solution. Once we complete this, then I will give a break. Such that after end of a concept, we will take a break. It will be clear also for you. So if you read the question, tell me. Have you completed reading the question, everyone? Everyone, have you completed reading the question? Okay. Hmm. Let us start with doing the problem. See here. Mr. A is thinking of buying the shares at 500 each, face value of which is 100. He is expecting a bonus in the ratio of 1:5 during the fourth year. So dividend will not come in the fourth year. Okay, from the fifth year onwards, dividend will come. Annual expected dividend 20%. Dividend rate will be on expanded, means on the bonus share also, dividend will be paid. Okay. Shareholder intends to sell the share at the end of seventh year at expected price of 900. This is ex-dividend. Always whenever question is silent, it is ex-dividend. If question says come dividend, then only come dividend share. Incidental expenses at the time of purchase and sale, 5% on market price. Next, she expects a minimum return of 12%. Okay. Let us start doing it. Question number 22. Keep the heading. Step 1. Calculation of purchase price. Calculation of purchase price. Number of shares, he did not tell anything. So let us take for one share and do the answer. Nothing is said, na? Say 1 into what is the market price per each share? What is the market price per each share? At what price he purchased? See, 500 he is purchasing. Okay. And next, on that, there is a incidental expense of 5%. 500 into 1.05. 525. Next, step 2. Calculation of number of bonus shares and total shares. Number of bonus shares and total shares. First, existing holding 1 share. Write down along with me. Bonus ratio 1:5. So number of bonus shares. For every 5 shares, 1 share. I have 1 share. So I will get only 0.2 shares. Whether 0.2 shares practically possible or not, you don't tell. If you calculate for 1.2 shares, even 12 shares also same answer. Okay. Next. Total number of shares. Calculation of bonus shares and total shares. Total number of shares is 1.2 shares. Step 3. So first one is calculation of purchase price. Second one is number of bonus shares and total number of shares. Okay, number of bonus shares and total number of shares. And next one, step number 3. See here, the shareholder sold the shares at the end of 7th year at a price of 900 each. Share is sold at 900, but I have 1.2 shares. Okay, write down. Calculation of net sale proceeds. Okay. So write down clearly. Sale consideration 1.2 shares into 900 each rupees. 1.2 into 900. 1080 minus purchase consideration. Sorry, I'm very sorry. Yeah, very sorry. Here we are not calculating any capital gain. So sale consideration is how much? 1080. But this 1080 is not completely coming to us. Reason is there is a 5% incidental cost. Okay, 5% incidental cost. Very sorry. Write down. Incidental expenses at the rate of 5%. Sorry. One zero two six. This is the net sale profit. Next one. Step 4. Valuation of holding. Valuation of holding. Okay. Write down the valuation of holding. Year. Cash flow. PV at the rate of 12% if I am not wrong. PVCF. Okay. Year. 2, 3, 4, 5, 6, 7. 5, 6 and 7. Year. First year. How much is the cash flow here? How many shares I am holding? 1 share. 1 share. What is the face value? 100. Into what is the dividend rate? 20%. Okay. So when the dividend is declared during 4th year. From 5th year onwards, you will get the dividend also on the expanded capital base. Okay. Previously, it is on a original capital base. 567 will be on the expanded capital base. Okay. So valuation of the holding. So write down here. First, how much is the dividend that will be paid to me? 100 into 20%. How much? 20. Okay. Next. 5th year. 1.2 into 100. I will write the workings here itself. 1.2 into 100. 24. 24. 7th year, be very careful. you will get two cash flows. One is 24, another one is 1026. So totally you will realize 1050. What is this? 1026 is the sale. 24 is the dividend because it's ex dividend. Previous one is cum dividend. Therefore, separately we will not again consider them. Okay. Next, PV at the rate of 12%. Okay. Do the calculations and tell the value, everyone. Do the calculation. 20 into 0.893, 20 into 0.797, 20 into 0.712, 20 into 0.636, 24 into 0.567, 24 into 0.507, 1050 into 0.452, 561.14. 561.14. Have you got the answer or not, everyone? So, value of holding equal to 561.14 minus purchase consideration. Here we will reduce 525. So, the NPV positive rupees 36.14. So, at 12%, he is getting excess value. Okay. For example, if it is equal to 561.14, for example, value is 525. Let us say, for example, value is 525. What does it mean? Then whatever value you get and whatever you purchase, both is same. That's called as a IRR situation. Means you are getting exactly 12%. You are getting NPV means you are getting 12% or more than 12 or more than 12. Therefore, see here. Should Mr. A buy the share? Yes. What is the maximum price he can buy? He can pay. Maximum price what he can pay? Maximum price is 561 because if you pay beyond 561.14, your NPV renders negative. Okay. So see here what he said. He expects a minimum return of 12. Yes, you are getting minimum return of 12. Write down there. Conclusion. It is recommended to buy the share since return is more than 12%. Number two, since the return is more than 12%. Number two, rupees 561.14. If you want, you can add a point after which the NPV renders negative. After which or above which NPV renders negative. Above which the NPV will render negative. So with this, we completed buyback and its impact on the wealth. Everyone listening to the class should answer, understood the discussion, calculation, working everything clearly or not. Everyone who are listening, understood all the concept clearly or not. Yeah. With this, we completed last but third one. Okay, that's also over. Next segment we are going to start is buyback and its impact on wealth. Keep the heading. Okay, keep the heading. Buyback and its impact on wealth. Buyback and its impact on wealth. Okay, so take a break and come. Once you complete the break and come back, we will first do the concepts on buyback. Okay, we'll try to complete the entire buyback segment itself in the today's session. If at all only rights issue is pending, two problems will be pending. The two problems we'll do the next session and close this chapter. Okay, no rush through the concept. Without completing the concept, just like that, do the problems and complete just for namesake. My chapter is over. Let's not do like that. Okay, let us do it in a right way. What is the right approach? Let's follow that. Let's complete the buyback after the break. Okay, thank you very much. Take a break and come. Okay, so the next question is question number 11. A November 2024 6 marks question. Okay, let us read this question. A Limited has a surplus cash of rupees 80 lakh. It wanted to distribute 30% of this to the shareholders. The company decided to buy back the shares. It is estimated that its price after the buyback is 10% above the buyback price. Other hint given, number of shares outstanding is 10 lakh. EPS is 3. What we are going to calculate? The price at which the shares can be repurchased. If the market capitalization means total market value after the buyback is rupees 180 lakhs. Number of shares that can be repurchased. So, before we start with this, I have certain points to tell. Number one, there are two questions on buyback in our book. Anywhere you see study material RTP buyback, two questions are there. Number one, number 10. Number two is number 11. Okay. 10 is talking about the impact and analysis of buyback. Okay. Impact and analysis on buyback. That's a very litigant question where we will understand in and out why companies go for buyback, how to go for buyback. If buyback happens, what will happen to the wealth of the shareholder? Each and every aspect of this buyback, we are going to understand. Okay. That's question number 10. Question number 11 is a general buyback calculation. Okay. From the exam's point of view, if you ask, question number 11 is more important than 10. Then why you inserted 10? 10 helps you to understand how the buyback actually operate. That's an old study material question. Okay. Now that question is not there in study material also. Once upon a time it used to be there, but why I kept, you know very well. With one question, I will explain the entire concept. Next, after that, we will go into problem solving. Okay. So we are now starting with question number 11. A question which came in examination November 24, the latest exam came for 6 months. It came from the hand notes only. Numbers change, concept is same. Okay. First, how much is the surplus cash? 80 lakhs. In that 80, they wanted to distribute everything or only 30%, 30%. Next, 30% means 24 lakhs. Next, company decided to buy back. Okay. They have given one hint. What is the buyback price? We don't know. But we know one thing. Buyback after, the price will be 10% more than the buyback price. Means if the buyback is X, okay, post buyback share will be 1.1x. Okay, 10% means what? More than 10. 1 plus 10% means what? 1.1. So X is the buyback means 1.1 will be the price after buyback. Number of shares outstanding means number of shares. How many shares are there? 10 lakh. Observation required. Buyback before 10 lakh shares are there. Buyback after, number of shares should rise or number of shares should fall? Everyone answer. Those who are on the chat. Tell me. Number of shares will be raised or number of shares will be fall? Please, please. Fastly, sir. We will complete buyback. We must complete buyback in the today's session. Okay. So 10 lakh will not be 10 lakh, will be less than 10 lakh. How much? We don't know. Okay. I will give you an example here. Okay. Everyone tell me. How many lakh shares are there? 10 lakh shares. In that, some shares will be bought back. Okay. How much? 24 lakhs worth shares will be bought back. Okay. But we cannot write like 24 lakhs worth shares. 24 lakhs is the available cash to make a buyback. To make a buyback. 24 lakhs is an available cash after buyback. Okay. Sorry, for the buyback purposes, 24 lakhs is available. Now I will ask a question. Take calculator. Take calculator. 24 lakh divided by, say for example, buyback is made at 500 rupees. Divided by 500. 4,800 shares will be bought back. That is the question he is asking in the second bit. Example 500 I said. So 24 lakh divided by, buyback is at 200 rupee. Divided by 200. 12,000 shares are bought back. So like this, we should first know the buyback price. If you know the buyback price, then divided by the 24 lakh divided by the buyback price will give you the number of shares bought back. Okay. First of all, everyone answer. Did you understand the discussion clearly or not? Everyone understood the overall logic of this question or not? Okay. Listen now. I will do it and I will give time for you to copy. Please listen carefully first. Question number 11. Question number 11. See here. First, step 1. These steps you can write along with me. These steps you can write along with me. Working will be there. That I will do first and I will leave time for you to copy. Okay. Write down. Step 1. Write down step 1. Write down step 1. Calculation of buyback price. Write down. Buyback price is X. Buyback price is X. Right. You add one point here. Post buyback. I'm very sorry. Post buyback price. Buyback price is X. Plus. Okay. $1.10x. Next. Step 2. Step 2. First one, calculation of post buyback price. Second step. Second step. Calculation of buyback price. Calculation of buyback price. Calculation of buyback price. From here, I will do first. I will give enough time for you to copy. Okay. Please listen first. There is a hint. Okay. On the base of hints, I will go. The question hints are given. What is that given? See, surplus cash is 80 lakh. In that 30% will be distributed. It is estimated that share price after buyback is 10%. Number of shares outstanding 10. EPS 3. Price at which it can be repurchased if market capitalization after buyback is 180 lakhs. Okay, listen first. On the basis of hints, we will go. Market value, don't do please. I will do first. Market value post buyback is rupees 180 lakhs. Okay, next. Market value means what? Market price per share into number of shares. This will be equal to 180 shares. Okay, next. Market price of what? Market price post buyback into number of shares post buyback is the market value post buyback. So we will further divide them, further break them. Market price per share post buyback is 1.1 times the pre-buyback price. Already we know that or not? It will be 1.1x. Market price per share after buyback into number of shares is a market value after buyback. So market price per share after buyback is 1.1x. 1x into number of shares post buyback. This we know na? We don't know. We know one thing. Number of shares post buyback can be written as number of shares pre-buyback minus bought back shares number of shares pre-buyback into bought back shares will be called as number of shares post buyback. This will be equal to rupees 180 lakhs. Further we can divide it. 1.1x equal to what is the number of shares pre-buyback? 10 lakh shares minus what is the buyback shares? Number of shares bought back means how to calculate? 24 lakh cash is available divided by buyback price. Buyback price is X. This all will be equal to rupees 180 lakhs. First of all, everyone in the class who are listening live, answer my question one by one, step by step. I am breaking that into meaningful parts. Understood or not? Frankly, you tell me. Understood all the steps that I am writing. Step by step, I am analyzing it. Market value is nothing but market price per share into number of shares. Post buyback market capitalization is 180. Means post market price, post number of shares required. Okay. Market price post buyback 1.1x already we done in the first step into number of shares post buyback means what? Number of shares pre buyback minus buyback shares. Okay, but buyback shares we don't know how many shares will be bought back. 24 lakhs amount is used at some buyback price of X. Okay. Now further let us break this. Okay, wow. 10 lakhs minus 24 lakh divided by X equal to 180 lakhs divided by 1.10x. 1.10 goes to the other side, it divides. 1.10x. Okay. Further, let us calculate. 10 lakh x minus 24 lakh divided by x equal to 1 crore 80 lakhs divided by 1.1 rupees 1 crore 63 lakh 63,636 divided by x. X cancel. Further it boils to 10 lakh x minus 24 lakh equal to 1 crore 63 lakh 63,636. 10 lakh x equal to 1 crore 63 lakh 63,636 plus 24 lakh. 1 crore 87 lakh 63,636 x equal to rupees 18.76. What is x buyback price? Therefore, buyback price equal to rupees 18.76. First point, everyone. Answer, did you understand the workings clearly or not? Reply first and then copy down. Everyone understood the workings clearly or not? Up to here, I re-explained now. Later, 1.1x went to this side, divided 10 lakh minus 24 lakh by x. X is a common LCM. 10 lakh into x minus 24 lakh whole divided by x equal to this one. 1.1 cancels this and become 1 crore 63 lakh 60,636 by x. When denominators are equal, numerators can be equated, denominators cancel each other. Okay, these are all basic mathematical rules. Na? So 10 lakh x minus 24 lakh equal to this much. We took it to the other side, and the final price is 18.76. Up to here, everyone answer understood or not? Clear? One step complete, second step over. Last step also I will write and give time for you to copy. Number of shares bought back. Number of shares bought back. Okay. Rupees 24 lakh. Buyback price is how much? 1,27,932. Okay. Please copy down the answer now. That's why I said in this question, nothing about buyback we are going to learn. It's a calculation only. Just normal share value calculation type. We are going to calculate missing figures. Completed copying. So once you complete, please put a message. We will continue with the next question. That's very interesting aspect of buyback. Okay. Let us come to the next area of the buyback. Buyback analysis is the next topic. What is the next topic? Buyback analysis. Okay. Keep the heading. Buyback analysis. Buyback analysis. Okay. Take question number 10. This question is over. Take question number 10. Take question number 10. So once this question is also completed, we are done with this area called as buyback. So separate session, we will cover all the rights concepts as the rights also will be done. Okay. Buyback is the main area which requires completion. So let us do. Okay. See here. Buyback. So first thing, let us first understand some basics. What is a buyback? Companies Act says that buyback is called as a repurchase of shares by the company itself. Repurchase of shares by the company itself. For understanding sake, I will give one example and I will explain. Okay. Buyback will be made out of three sources. Source number one, free reserves, securities premium, and fresh issue of shares. These are the three sources out of which buyback will be made. Some instantaneous points of Companies Act I will tell you first for you to understand the financial impact and how the makers of the law, when they start preparing the buyback section, with what motive they have written those sections. Section number 68, subsection number 7, read with section number 68, subsection number 1, read with section number 68, subsection number 2, read with number 69. All these things I wanted to just sum up and try to explain in one go, such that you can really appreciate the lawmakers' intention of bringing the buyback as a section under the Companies Act. Okay. So after that, you can really understand lawmaker made provision like that means there is some impact. Sir, I will give you an example. Yeah. Okay. I will give you an example. Whenever law is drafted, okay, whenever a law is drafted, law drafting will be always done on the premise of the practicality. Law, whenever is made by two types of experts. Number one is the legal panel. Number two is the industry panel. Legal panel consists of chartered accountants, company secretaries, Supreme Court retired judges, High Court retired judges, court judges other than High Court, Supreme Court. Okay. Okay. Next, lawyers having extreme knowledge in a particular field, ICLS candidates, not IAS, ICLS, Indian Corporate Law Service, ICLS graduates. All these people has formed the company law committee. Company law committee, these all people are there. Legal experts will prepare the law. Industry experts will give the inputs for making the law. Example, I will tell you. A person who always sit in a practical stage will always have a better knowledge on the impact of a particular thing on them. I will give an example for this. You can understand. This is a very popular example. Okay, if not known, okay. If known, now you can really connect to this. If not known, also you can connect. Listen. There is one old Telugu movie released way back in 92, 93 time. Okay. I don't want to reveal the name of the movie. I will reveal at the end. Director is Manratnam. Okay, one of the legendary directors at that time. And not at that time. Now also he's a very good director. So he is the maker of classic films in Telugu, Hindi, Tamil, every language, every possible language. He is a veteran director in Tamil and Telugu. And he is also well known for his good amount of movies in Hindi. And he is one of the most classic director in the history of India. He is one of the good directors. What happened is, Manratnam made one movie, 92, 93 time. Once the movie is made, okay, it started playing in all the theaters in Andhra. It's a first straight Telugu film for Manratnam in Telugu. Before that, he did not make. Cinema movies like Mauna Ragam, all these things are made. Those are released in Tamil, dubbed into Telugu. But this is a straight Telugu film of Manratnam which is released in Andhra. It was released across Andhra Pradesh. Movie became a decent hit. Now it is a cult classic. But at that time, it is not so much hit. Okay, very good. Very good movie. Okay, Manratnam got a huge applause. Ilayaraja being the music director, music is a sensational hit even till today. So this is the situation of that movie. That movie started playing in entire Andhra circuit, where it played for 80 days in some centers, 90 days, 100 in around 11 to 12 centers at that time. But in one center called as Vijayawada, it played for 178 days in a theater called as a Santi. There is one theater in Vijayawada. I am from Vijayawada only, na? So we are very much connected to all the movies. So it was played in Vijayawada for 178 days. So then Mandatnam got a doubt. Movie became a super hit. It was played across Andhra. And in one center, it played for more than 170 days, 75 days. It's a silver jubilee in one center. Why it is played for 90 days, 100 days in some centers, and only in one center, why it is played for 175 days and plus? Something might have happened. So what the movie crew decided, let us celebrate silver jubilee functions in that theater itself directly. They came to Vijayawada. Crew, 7 people from Manratnam side, music director, Mr. Ilayaraja, editor, screenplay writer, Manratnam, and important cameraman like that. Important crew, 7 members came to Vijayawada to celebrate and watch with the audience on 178th day. That's the last day of the movie. Silver Jubilee function. They came. Public came, everyone came, sitting in theater, huge applause for the movie. Everything is going well. They sat with the audience and they are watching the movie. While watching the movie length is originally 2 hours 54 minutes. 2 hours 54 minutes is the length of the movie. Okay. He know everything. Interval should come somewhere around it, 1.5 hour or 1 hour 20 minutes like that. Interval should come. From then another 1.5 hour say, a movie should be there, 1 hour 20 minutes like that. Exactly after 1 hour 2 minutes interval came. He was shocked. So many scenes are missing in this movie. Then he asked other crew also, in this, after this scene, another scene should come, na? Another song should come, another scene should come. Why it is not there? Immediately he thought of this, and sir, he said, maybe we are only missing, maybe the movie is like this. He said, exactly at 2 hours 26 minutes, ki movie completed. Okay, movie completed 2 hours 26 minutes. Then Mandatnam got a doubt. Movies for 2 hours 50 minutes, almost nearing 3 hours. 2.5 hours no movie completed. What is going wrong? Let's go to the projection room, he thought. He went to the projection room. Projection room, at that time, reels used to be there. Now it's a digital UFO. At that time, digital playing is not there. It's only on running on a reels. So he went to the projection room. That person who plays the projection, that person is sitting happily having a cigarette. Immediately call that person, what is happening here? Movie is not there properly. It was cut in various places, like the movie was missing. Please show the reel. They started opening the reel. Okay, reels la movie will be there. So they started seeing all the reels one by one. After 25 minutes of the movie, reel was opened. There is a capstan cigarette kept there. At the time, capstan cigarettes used to come. Capstan is a very long cigarette. Okay. At that time, it is economical and more consumable. Means it will be for around, maybe the person's expert will know about the timing. So the timing it will last long. That's how they advertised also. That's how they advertised. At that time, Kamal Hassan is the brand ambassador for Capstan cigarettes. So Capstan cigarette was kept there in the reel. Okay, reel was wounded. Again, there is a Capstan cigarette. Two Capstan cigarettes. Reel was wounded. Okay, so the reel is running to one side. Capstan cigarette will come. Okay, that means the reel will be missing. Another scene will come. Again, Capstan cigarette will be there. This to this, he cut the reel and he attached the reels again. Like that, several places, 6 minutes, 7 minutes, 8 minutes, 9 minutes, like that, bits and pieces. La, Capstan cigarette was kept and reel was cut. This is the situation happening in the theater. Clear? What happened in that theater where Capstan cigarettes was kept by the projection man? Movie played for 175. That's in Vijayawada. So what is the situation? Then Mandatama, idiot or what? Who gave you right to do like this? Movie is for 3 hours. Sir. Why you played only for 2 hours 26 minutes? Sir? Say some logic for this, or else I will make the police to arrest you. He said, sir, don't do that. I've been watching this movie for the last 175 days. Sir. First 10 days I watched the movie. People are walking out of the theaters in some scenes. Wherever they are going, I am seeing from there from the projection room, I kept a cigarette. Such that during that particular scene, I will keep the cigarette, I will cut the reel. Such that people will not feel bored, sir. That's why I kept. Then Manratnam was shocked. I am the director. He is a screenplay writer. That idiot is an editor. These people don't know all these things. Just because you are sitting in a projection room and seeing the impulses of the audience in this theater, you kept a Capstan cigarettes there, managed to cut the reel. That's why movie is playing for 135 days in this theater. All the nonsense, logical scenes and other scenes where the songs are coming suddenly, cut, play. So that movie played for 175 days in Vijayawada. That person who did this is called as Yatiraj. That person is now into the team of Manratnam. In the last 27 years, he is in the team. Why? That fellow is called as an industry expert. I may not be educated. I may not be literate. I don't know anything ABCD about the cinema. But I have the logic and sense of grasping. Okay? Logic and sense of grasping. Where the audience impulses are getting affected badly and positively. Hopefully, everyone understood what I said. And the name of the movie is Geetanjali. If Buyback doesn't understand, no problem. At least understood the story properly. So, the point what I wanted to tell is, logic is very simple. Yeah. Lawmaker, whenever they write the law, like a fool, they don't write the law for exams. They will put industry experts, legal experts, and then they will draft provisions. Just like that, for the sake of writing the law, they don't write. That's why every section in the law has a meaning. Okay, like a fool, we should not read the law. Adi direct tax, GST, company law, FEMA, insolvency code. Keep all the things aside. Law has to be read in the way it has to be read in order to become a successful practicing chart accountant. No, sir, I don't want to practice as a CA, sir. I will work under someone, sir, always in life. Never I will work for my individual sake. I will work under someone. Okay, my life is always to do cut up a job. Okay, if he says something morning 8 o'clock to evening 10 o'clock, I will work under someone, sir. That is my attitude. Then no problem. You need not learn anything. Examinations are over. You will pass. You will qualify as a CA. Very good. Fantastic. I am very happy for you. If you wanted to become a successful chartered accountant in life, earn money, earn respect, and earn a happy life, and without working under someone, the only choice is practice as a CA. Okay. So if you practice as a CA, what will happen automatically? You have to read the Bare Act. Technically, I goes to NCLT every time. Okay, I go to the income tax tribunals all the time. So how we can manage? If you know the Bare Act properly, if you know how to interpret the provisions of law, then you will become successful. You can speak with someone about law. No, sir, I will do all analysis, sir. Summary book, sir. My batch is summary batch. Okay, I am all summary batch candidate. Summary book you give, I will read exam 55. All 50s I will pass. then you are a half chartered accountant. Really, institute wanted to convey that indirectly. Half knowledge people will become CA. That's why 50 is a pass mark. That's why IAS marks are not there. So the point is, these half knowledge candidates, once they qualify CA, how it will be like this only it will be. So the point is very clear. To be very frank, understand the scenario. Why I'm saying this is, buyback is such a concept which always connects me very well, because I wanted to salute the makers of the law. How come you are getting these kind of ideas? I wanted to just ask. Like this, I will get the thought process whenever I see something very new and unique. When I read Dr. K.R. Chandrathre's Companies Act, okay, when I read V.S. Wahi's Insolvency Bankruptcy Code, when I used to read some books which really give me an impression, how come these people are alive in this world? Such a great person, sir. K.R. Chandrathre. There is one person called as Dr. K.R. Chandrathre. He is an expert in company law. His books, if you read, very level. So, Companies Act, if you read, as if scenes are happening in front of your eyes. Means it's like a screenplay. When you read a very fantastic novel like J.K. Rowling's Harry Potter, when you read J.K. Rowling's Harry Potter, 3.5 Men, when you read the novels, okay, characters will come in front of you. Means though you are reading the book, when you see like this, characters will play in front. That's possible only for a few people. As far as I know, J.K. Rowling for the Harry Potter, 3.5 Men. When I see these kind of novels, I will get the thought process. These kind of people are alive in this world. So the point is, same like that, I will get that adrenaline rush. Whenever I read Companies Act, income tax, whenever I read sections, blood to boil. How these people are writing this law? Each and every section, twist, bang, every scene, climax, how they are writing. So buyback is one such section in section number 68 of Companies Act. Do you know what Companies Act buyback said? Buyback, if you understand as a section, you can understand the financial impact as well, because these finance experts sat with the lawmakers and they made to draft the law. Therefore, you will understand the legal impact and financial impact all together. See, then you will understand the taxation on buyback in income tax. Taxation on buyback. Reduction of share capital is there, na? Reduction of share capital, section 2, clause 22. Buyback impact on capital gains on buyback is there. Reduction of share capital impact is there. Section 2, clause 22, section 2, clause 22, subclause number D, liquidation impact is there. All these you will understand if you understand the legal impact of all these sections. Let's see. Companies are going for a buyback. Companies are going for a buyback. Whenever company go for a buyback, buyback will be made out of three sources. Free reserves, securities premium, fresh issue. Means what are the sources used? Free reserves. Means reserves available for distribution of dividend. Securities premium. Securities premium. Premium collected on issue of shares. Next one, fresh issue. Okay. Next one. Number 2. Whenever you make a buyback out of free reserves and securities premium, okay, you have to transfer nominal value of the shares bought back to an account called as capital redemption reserve account. Which account? Capital redemption reserve account. Whenever the buyback is made out of free reserves and securities premium, an amount equal to nominal value of the shares bought back should be transferred to an account called as capital redemption reserve account. So the logic, sir, why I need to transfer? Next, I will tell you another point also. Whenever buyback is made, before making the buyback, company has to file a form with ROC called as declaration of solvency with the ROC. Next one, debt equity ratio post buyback should not be more than 2:1. See, randomly so many scenes are there. These scenes are all connected. A proper editor, when he teach Companies Act, a proper screenplay writer, when he narrate the story of company law, it takes to a different level. One by one I will explain. Then we will come to the buyback analysis, because I don't want my student to just read buyback as a problem. I want you to know the holistic understanding of what is this buyback concept. Whenever company go for a buyback will be made out of three sources, as I said. But free reserves, securities premium, fresh issue. These two, whenever you do, nominal value of shares bought back, that value should be transferred to capital redemption reserve account. Fresh issue ki no transfer to CRR. Why? Student don't want all these things. He just want an answer. When CRR is created, when the buyback is made out of free reserves and securities premium, then an amount equal to nominal value of the shares bought back is transferred to CRR account. Why? Don't ask me. We are summary batch. This is the intention. For them, what I should teach? For them, what should I teach? I want only summary. I want only no logic required. I just want 40 marks in exam, 50 marks in exam. He want out bauchiled. So the point is, if you really wanted to know how the buyback actually works in a real life, okay? So see, what they wanted to tell, transfer this to CRR account. Transfer this to CRR. Declaration of solvency. All are interconnected, irrelevant points. CRR account, declaration of solvency, debt equity ratio 2:1. Correct or not? Fresh issue, what are all these interconnected points? Clear? So let us try to understand clearly. Originally, previously, I will just tell the example for you to understand. Originally, long back, first tell me, are you all listening? Everyone in the class? Are you all here? Everyone, Abu Bujji, Kanna, Chitti, everyone listening? Everyone is not reacting, and that means you are listening like this. Geetanjali movie, very good, nice example. Now buyback, like that you are listening. Sir, listen. So the point is, whenever buyback is made, declaration of solvency is required. Okay, I will give you an example. Originally, long back, when movies are getting released, we used to go to the physical counters and take the tickets. Let us take that example. Ticket counter. First day, first show, people like me, what they will do? Okay, people like me, what they will do? Yeah, obviously, I am a die-hard fan of Chiranjeevi. Die-hard fan means I can't explain in words. Okay, that much die-hard fan. Raktabhishekam batch. Chiranjeevi movie release na, Raktabhishekam Chiranjeevi. That much big fan I am, not normal fan. Okay, Chiranjeevi is my hero. Chiranjeevi is my villain. I failed in CA Inter just because of his movies. Movie will be released exactly in the month of September, November exam. Movie releases during summer. April it will be released during summer holidays for 10th and 10+1 and 10+2 intermediate students. Okay, at that time movies will be released. May exam gone. Varasa 2 examination fat over. One movie, okay, during at the time when I studied CPT, Stalin movie released. Fat foundation first attempt fail. Okay, how weak I am when it comes to Chiranjeevi, I just wanted to tell. Okay, movie released. Okay, September it was released. November exam. Okay, do you know how many times I watched that? 24 times I watched the movie. Movie is an average movie only. And I mean, okay, not so great, not so low. But just to see him 24, 25 times. How that 24 will come? First day, all 5 shows. Hello, one show also we will not leave. All 5. Morning 3:30 show is there. After that 9:30. After that 2:30. After that 5:30. After that 9:30. All movies, 5 shows. Till when? Shall I tell you? Last 2 years back, 2 years back, 2023 year. 2023 year. Okay, one movie called as Walter Viraya was released. Okay, I was in Chennai at that time. I don't want to watch in Chennai. Okay, because I wanted to see in the main theater, that too in Vijayawada. So I was taking classes for CA Inter Law. I stopped the classes all of a sudden. One day before, I took flight, came to Vijayawada, watched the movie. Morning show, morning 2:30, fans show was made. Benefit show, 2:30, 8:30, 12:30, 4:30, 8:30. All 5 shows. So, that much movie freak I am. When I love something, I love in extremes. When I don't love, I will not take care of that. So extremes only I will do. Once upon a time when I was studying my 10+2 like that, okay, at that time one movie got released called Shankardada MBBS. Same situation. Counter starts there in Apsara Theatre in Vijayawada. From there, if the line starts, it will be continued for around 1.5 2 kilometers. So, person having a huge following, that much craze, I want to watch him only on the day number one, first day, first show, or else I will die that day. So by hook or crook, I have to go to the movie. Whatever may happen, I should watch the movie on that day. So this is the situation. Ticket counter is here. Okay. So many people are standing in the line. My examples never get wasted. Listen. So many people are standing in the line. Thousands of people. Okay. You ask me what is the craze of megastar and at that time. So he is one of the most celebrated Indian superstars. So what happened? Line is there like that. Thousands of people used to stand in line. I was one among, obviously. Okay. So let us say, for example, I am standing here. Last person. I saw the queue. Okay. I saw the queue. I'm standing here. I saw the queue line. 600-700 people are there. 600-700 people means I will not get the ticket because theater number of seats will be restricted to somewhere around 600-700. 600 people in front of me means theater will book some tickets first. They will keep it aside. Okay. So for celebrities and other people to come. Okay. Now I am the celebrity. Vijay tickets means that theater row I can book now. At that time when I am a bacha, knicker bash time. So point is this is the scenario. I was standing in the last line. Then I saw 600-700 people are there in line. I understood. No, today I will not get the ticket. Then what I will do? Let them tell whatever bad words in Telugu. Don't care. Our intention is to watch the movie today. So what I did is ding 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 ding. I trespassed everyone. I stood in the line like this. Okay, I came here. All the people at the back are falling on me. Jay, how can you come? Like that. They started using all bad words like Suprabhata Seva. I heard everything. Thank you very much. Your efforts. Okay, your bad words. Keep it with you. What Gautam Buddha said. You say 1,000 bad words. If I take, then I will become that. I will not take. You tell whatever you want. So you say, so all good words in Telugu, they will use. Obviously, it happens. They are waiting from the morning now. But I don't care. Here, ethics don't play role. I want to watch Megastar on first day, first show. Okay, my throat should die that day. So I should sit in that front dance as a Chiranjeevi when I see the emotionally how much energy I'm getting all of a sudden. So this is the scenario. This is what the example is. I stood here now. Okay. Now imagine the scenario. I took the ticket. I went. Immediately, theater person kept a board, house full. Now tell me, these all people, okay, these all people will now come to me. Arey, I will kill you. Now what I will do? I will run away. Correct? Correct or not? So these all people wanted to kill me. I will run away, obviously. Why I will stand there? So in this scenario, I wanted to explain. Okay? Now listen carefully. When they give me a ticket, all the other people's emotions got hurt or not. Why? There is a houseful board here. Same concept applicable also for buyback. In a company, whenever distribution of money is made, distribution should be made in a pattern. First pay to workmen, second pay to employees, third pay to secured creditor, fourth pay to the government, fifth pay to unsecured creditor, sixth pay to preference shareholders, seventh pay to the equity shareholders. Means equity shareholder will be like me in this example. Means what? They should be at the equity shareholder should be at the last like me. So the equity shareholder who should get the distribution at the last suddenly came, got the distribution at the first, and he's going away. Clear? Immediately after equity shareholders taking the money, who is not authorized as per the sequence, after him, theater la houseful board, company la insolvent. Houseful means what? Tickets are not there. Insolvency means what? Money not there. Therefore, directors of the company must give a declaration of solvency. Babu, all others standing in the line, no problem. Even though I give him tickets, still more tickets are there. If they can show that, then these all people, okay, leave him. Anyway, tickets are there, still we can take. Like that they will feel. Now, did you understand what is the logic of the declaration of solvency or not? Now you understood the declaration of solvency or not? So that's why Companies Act section number 68, subsection number 7, they have written Directors of the company must file a declaration of solvency and should give a declaration that they have investigated and inquired about the affairs of the company, and the company will not become insolvent in the next coming 1 year. This is what actually the Bayer Act quoted. Okay, so that's the reason why they have to give a declaration of solvency whenever the company goes for a buyback. This is the first logic that I wanted to explain. Okay, declaration of solvency concept completed with this. Okay, next. Sir, what is this fresh issue? What is this fresh issue? Question will arise or not? Okay, listen now. Listen. What is this fresh issue? Let us when I say assumption. This is India. Don't believe? Pendant also drawn. This is India. So Lanka makes this India. So this is India. Let us assume. Okay. Deem that this is India. Border law army is there. Border law army is there. Who is army? Army is who protects the people inside India. Inside India, all the people are protected by the army. Okay. On all the sides. Let us take an example. There are 1 lakh army in the company. How much? 1 lakh army in the company. Okay. 1 lakh army, they are there in the border standing for our protection. People inside India are very happy. People inside India are very, very happy. Since they are working in the border, people inside are extremely happy and peaceful. Okay. Now you answer. From the army, 10,000 people said that we are withdrawing ourselves. We don't stand in army. We are coming back. Okay. Now you tell me, if army comes back, if army withdraws their efforts, risk is to the army, risk is to the citizens inside India. And technically, risk is to the army or risk is to the people? Answer. Now everyone understood now? Risk is not to the army, risk is to the people. Okay. We are secured. These people are unsecured. When the unsecured people who are taking care of our security comes out, we will become unsecured now. Understood the point or not? We will become unsecured. So army said 10,000 comes out, danger. 20,000 came, more danger. 50,000 came, you are gone. Okay, that means exit of one person leading to the effect of another person. This concept a buyback. In the company, the defense mechanism, the immunity is equity shareholders. The risk of business, equity will take. Damages of business, equity will take. Are you understanding? Success of the business, they will only take. When I take risk, I will take the return as well. So when I take risk, I will take compensation for the risk taken. Equity shareholders always take the risk. Entire business risk. Sales are dropped, shareholders will get affected, because irrespective of sales, debenture holders should be paid money. Debenture holders should be paid money. Okay. Now listen carefully. Because who is going to take the risk? Equity shareholder. Because company raise money, purchase assets. Assets belong to equity. If I don't pay the debts, debts are secured. Debts are secured. They will sell the assets and take the money back. They will sell the assets and take the money back. But listen carefully, point. Okay. I will ask you one question. Tell me. Defense 1 lakh army are there. 10,000 were withdrawing and they are coming back. Riska, no riska means risk. I will ask you one question. Tell me. If government says, listen carefully. If government says, okay, 10,000 people who are coming back are above 35 years. They are not fit for physical army presence. We are putting them into clerical job. Newly qualified 18-year-old people, they are coming for 10,000 people are recruited. Are you understanding? Means old age army. Old age means army 40, 45, 40 years na old age over. So 40 years they cross. Therefore, we are withdrawing from the physical presence and putting in a clerical job. And the people, newly candidates are there. There are 10,000 candidates. We are putting them. Now answer. Withdrawing 10,000, putting another 10,000. Riskiya, not riskiya. Riskiya, not riskiya. Same thing. Same thing. Fresh issue, that's why CRR is not required. Because buyback you are taking back it and again you are replacing it with the equity. The difference called as equity reduced and again compensated. Therefore, compensation through CRR is not required. Everyone answer. Understood why CRR is not required in fresh issue? So, why CRR is not required is already for the bought back amount, we are again replacing. So, the defense is coming down. Equity come down means risk to the debt holders because they have to bear the risk. Clear or not? So, like that, when the replacement is compensated exactly, then problem will not come. Okay, this is the point here. Next, last point, and we will go into the discussion. Last but one, another point also there after this. When CRR is required, see here. When the equity share capital is coming down, sir, when you buy back, equity share, free reserves will come down. Free reserves will come down. From free reserves only you are paying. Free reserve securities payment you are using and paying them. Okay. Equity shares will be in the balance sheet at par value, market value, par value. Nominal value we call. Equity share capital will be at what value? 1 lakh shares of rupees 10 each. 10 lakhs is there. 10,000 shares are bought back. So it becomes 90,000 of 10 each, 9 lakh. Okay, this is the scenario. Means how much came down? 10,000 shares came down at 10 rupees each. Now, the defense mechanism of the company, the immunity of the company came down by 10%. Okay, if it is a fresh issue, obviously again it will be raised by another 10,000. Again it will become 1 lakh into 10 lakhs. But that is not the case here. What happened? I am using free reserves and I am paying them. So, fresh issue, I am not compensating. Free reserves are coming down. From this, what you have to understand, listen carefully. Reserves I have taken, I gave to the equity. Take these reserves. I have given the reserves. Reserves are profits. Profits I gave to whom? Equity shareholders. Okay. I said I am buying back your shares, take the profits. Over, done. One work is completed. Okay. Now listen carefully to the logic. But the immunity system also came down. The risk is to whom? Risk is to the equity. Do you know what I am trying to tell? In portfolio theories and asset pricing model, there is one concept called as a levered unlevered beta. In that levered unlevered beta, this is what we are going to learn one more time. How the equity reduction will impact the debt holders and overall risk of a company. We will see practically in the chapter. At that time, much more analysis we can make on immunity of the equity and debt. Okay. Now listen carefully. 1 lakh shares. 10,000 shares are bought back. Reduced. Immunity drop. Fresh issue not made. That means now immunity drop but compensation not made. Therefore, create a artificial compensation. What do you mean by artificial compensation? What they say is, you have reserves. From that reserves you wanted to buy back, na? Yes, I wanted to buy back. How much you want to buy back? 10,000 into 10, 1 lakh. If you want to buy back 1 lakh, you should require reserves of 2 lakh at least. You require the par value of 2 lakhs. 1 lakh you pay, 1 lakh transfer to CRR. Therefore, what they say, how much is the shares you are buying back? 10,000. What is the nominal value, par value? 10. How much? 1 lakh. You wanted to buy back 1 lakh worth par value containing shares. Yes. Therefore, same 1 lakh you transfer to CRR account also. What account? CRR account also. What is CRR? CRR as per section 69 of Companies Act subsection number 2, CRR can be utilized only for the issue of fully paid up bonus shares. To whom? Equity shareholders. Listen. Means CRR is a artificial equity capital. It is equity capital, but not in the capital form. Okay, because the conversion of CRR can be only into one form. What is that? Equity. So therefore, though 90,000 equity is seen, it looks like there is a immunity drop, but that immunity drop is now compensated not by fresh issue, compensated by artificial equity called as a CRR. Already reserves are given to the equity shareholders. Means profit is given to them, benefit is given to them. Double benefit they should not get. Therefore, CRR cannot be used to pay the dividend. because already profits came to you in the form of reserve transfer. Again, if I pay CRR also as dividend, you will get double benefit of profit distribution. I should not give you that. This is possible only to get converted into only one source, and that is equity share capital. Therefore, I will tell this way now. Final conclusion. India, 1 lakh army is there. 10,000 drop, 90,000. People are saying, army, 10,000 people came out. We will be gone. Then government said like this, don't cry. We have a reserve force of 10,000 strong army. Reserve, we are keeping them already. When war or some nonsense happened in the border, immediately these people will be recruited there. Now if they tell like that, people, okay, 90,000 now there. Now no disturbance. So 90,000 is enough. But when some disturbance start, this reserve will go to the army. That reserve here is the CRR. Understood the concept or not, everyone? Everyone answer? Understood? So the logic I wanted to tell is, this is the whole idea of a buyback here. This is why buyback whenever made, okay, companies whenever they are going for a buyback, they will go for, this is all written in the law. This is all written in the law. Means how much financial impact they understood and they drafted. Just like that, for you conducting exams to you, they did not write sections. Financial experts sat with them. They gave the input. Sir, this is how it will impact company. Okay. So final touch to this. Okay. Buyback whenever made. Why companies go for a buyback? For example, there is a company. This company is having surplus cash of, say for example, 1 lakh. Surplus cash of 1 lakh. They wanted to put this money somewhere. They tried. Okay, they tried to put it in a place where R is greater than KE. Walter model, if you remember. Okay, they tried their level best to invest in a place where R is greater than KE. They searched everywhere. Markets are very bad now. Therefore, they thought they can invest only in a savings deposit, giving them 4% return. Giving them 4% return. But the shareholders are expecting 10% return out of the money given. Okay. Shareholders are expecting 10%. Company has an opportunity to invest only at 4%. Therefore, it invested in 4%. Then what will happen? Let us see. Year, cash flow, PV at the rate of 10%, PVCF. Year, 0 year, I invested 1 lakh in a bank. Okay, I invested money in a bank. So 1 lakh is my outflow today. Today has a PV factor 1. 1 year after, my 1 lakh will not be 1 lakh. My 1 lakh will become 1 lakh 4,000. 1 lakh 4,000. This 1 lakh 4,000 will come today or after 1 year? After 1 year. Today's value is 0.909 for every rupee. So 1 lakh 4,000 into 0.909 gives us 94,536. 94,536. Technically, it is giving a negative NPV of 5464. Negative NPV of 5464. This is the present value. This is also present value. Your 1 lakh cash will become today only 94,536 if you are investing at 4%. Means wealth is grown or wealth is shrinked. Wealth is shrink. The objective of financial management is wealth maximization, not wealth depreciation. Okay, here wealth erosion happened. Who the hell you are to reduce my wealth? Like that shareholder will question you. Therefore, lawmaker said, shut your mouth, pay their money back. Whenever company cannot invest its money, whenever company cannot invest its money at a place where R is greater than KE, shut your mouth, pay the money back. You have no right to misuse the funds belonging to the shareholders. Everyone understood the point clearly or not? With that motive, buyback happened. Whenever R is less than KE, companies will go for buyback. With this, we completed the overall logic of why companies will go for buyback. Understood, everyone? Okay, understood the point, everyone? Now, so we now understood the logic behind this particular concept. Okay. One person asked the question, sir, but usually face value is way less than the buyback price. How some CRR really act as a compensation in real life? Listen carefully. Equity shareholders will take risk on the basis of a number of shares because EPS is on the basis of number of shares. Okay, EPS will be on the basis of number of shares. EPS is not based on market prices. Okay, number of shares is the motive there. How many shares are taking the risk of company is important. That's why CRR is created. Anyway, results will go out. Everyone know that. Correct. So compensation is not in terms of amount. Compensation in terms of number of shares. Number of shares are taking the risk. Hopefully, Bhanu, one person asked the question. CRR is not to be seen from amount point of view. CRR should be seen from the number of shares point of view. That's why nominal value. Okay. Sorry. Anyway. So surplus cash 1 lakh. All these things I explained. Na? Done. Okay. Listen. Take question number 10. Phi Limited has issued share capital of 1 lakh shares of 10 each, selling at 25. EPS 3. Surplus cash 50,000. They have following alternative. Pay dividend of rupees 5 per share. Okay. Use the amount to buy back the shares. So two options. Excess cash is there. If dividend is paid, if buyback is made, what is the impact he is asking? Okay. If dividend is paid, if buyback is made. Write down. Dividend payment. Dividend payment. So if you pay the dividend, what will happen? Okay, if you pay the dividend, what will happen? How much dividend? 0.5 per share. 0.5, 1 lakh shares ki 50,000. That's why surplus cash is 50,000. Okay. Find out PE ratio, MP, EPS. We will do reverse. EPS, MPS and PE ratio. Like that we will do. Okay. First, write down. Impact on EPS. Impact on EPS. Whenever dividend is paid, earnings will come down. Whenever dividend is made, earnings will come down. Okay. What is the surplus cash here? 50,000. What is the EPS? 3 rupee. What is the EPS? 3 rupee. Now, okay. How many shares are there? 1 lakh shares are there. 50,000 surplus cash is there. That surplus cash we are distributing in the form of dividend. In the form of dividend. Okay. So first answer number 1. What is the company's earning today? What is the company's earning today? 1 lakh shares are there. Rupees 3 per share. Rupees 3 per share is the EPS. Next, in this 3 rupee into 1 lakh, 3 lakh, this 50,000 is not there. We will assume that this is surplus. Okay, surplus cash 50,000. Okay, now listen carefully. Overall earnings of the company are 3 lakh. Okay, overall earnings of the company are 3 lakh. And 50,000 surplus is paid. I will show you the presentation and I will explain, then I will copy. I will write, you can copy. See here. Showing this, I can tell much easily for you. Okay. See here, through this I will explain you. Okay. First point. Given information, this question I will do like this. 1 lakh shares, market price 25, EPS 3 and surplus cash 50. If company declare dividend, what will happen? Let us see impact on EPS first. Okay, impact on is EPS. What impact will be there on EPS? No impact will be there on EPS because earnings before is 3 lakh. Now also earnings is 3 lakh. That 50,000 is not earnings, it is reserves. It is reserves. We are doing EPS. EPS will change or will not change. will not change because of declaring the dividend in this case. EPS will remain constant, assuming 50,000 is in excess of 3 lakh earnings. If the 3 lakhs earnings are there, means EPS will drop. Okay, 3 lakh is the this year profit. 50,000 is in the reserves, excess cash. We wanted to throw it out and pay the dividend to the shareholders. Okay, so because of that, EPS will change or will not change? Will not change. So that's what. Everyone copy down. Impact on EPS. It is surplus in reserves. It is surplus in reserves. Number 2. Impact on MPS. This I will do and I will show that. Okay. Impact on MPS. Now, the MPS of the company, if you see, 25 rupees. Correct? Okay. Right on. MPS pre-dividend, also called as cum dividend, before declaring the dividend, rupees 25. Dividend is paid. Reduce it. Rupees 0.5. MPS post dividend, rupees 24.5. Sir, always cum dividend, ex dividend means how to understand? Let us say, for example, there is a person who is having some cattle, cows, buffaloes, etc. That person went to a what to say, this cattle fair where cows and buffaloes will be sold, goats, sheep, etc. He went to a fair. All the cows were tagged with a rope to a particular shed. So hundreds of cows are there. A person went there to the fair. One person is selling them. He asked, how much is the cow? 50,000. Second person, 50,000. Another person, 50,000. Fourth person, 80,000, he said. Immediately this fellow asked out of curiosity, everyone is saying 50, then only I am bargaining. You are telling 80 directly. Why? Other person said, sir, this is not a normal cow. See properly. There is a calf inside it. In another 1 month, calf will come out. That means I am giving you double benefit. Bumper offer you are having. Okay. It's a double blockbuster. So therefore, this cow is not a normal cow, sir. If the cow comes out is a male cow, then you can use it for plowing, agriculture, everything. Female cow, dairy products, you can use it. So double benefit I am giving you. So, okay. That means if I individually buy 50,000, 1 lakh I should pay. You are giving me only at 80,000. Okay. Then he paid 80 and he bought the cow. Clear? That means inside the cow, there is a small calf. That is dividend. Okay. Now listen. Calf came out after 1 month. Now it is a normal cow. Now I wanted to put that for sale. Another person came to me. I asked him, you wanted to buy this cow? He said, yes, sir, I wanted to buy. I said, 80,000. He asked me, 80? Why 80? All are saying 50. I said, this is not a normal cow. Then he asked, normal cow, gada. Then what cow it is? This is having calf. Where? Born. Born, na? Inside that it is not there, na? Yes. So therefore 50,000 only. First one is the cow is a share, calf is a dividend. Okay. Therefore, that's called as a cum calf cow. This is a cum dividend share. Dividend come out, the value also will come down. Understood or not? Everyone understood? So, whenever dividend is reduced, it will become X dividend. Okay. So, MPS will fall. Impact on P by E. MPS 24.5 divided by 3. 8.167 times. 8.167 times. This is the impact of dividend payment. Impact of buyback. Impact of buyback. So how the buyback will impact? Let us understand. See, first one we completed 24.5, no effect. PE ratio will fall. Now PE ratio 25 by 3, 8.33. Now it came to 8.167 because of dividend PE ratio will fall. Next. So dividend impact over. Next one, what impact here? Next one is the buyback impact on the wealth. Okay, buyback impact on the wealth. Okay. See here. This I will explain directly from here. Later we will do. Okay. See. Whenever buyback is made, you should understand buyback is made at a market value. Therefore, balance sheet should be reinstated on market value basis. Balance sheet view for understanding only at market value basis. Okay. Listen. Surplus cash 50,000, other assets 24 lakh 50, 25 lakhs is the wealth. Okay. Equity 25 rupees, 1 lakh shares, 1 lakh shares. Equity 25 lakh. Okay. Once the dividend is paid, this cash will go out, it will become zero. It become 24 lakh 50. So share price will come to 24 lakh 50, 24.5. This is one way of understanding. Sir, I did not understand one thing, sir. What is this balance sheet? Surplus cash, other assets 25 lakh. Who said that is other assets? And you are taking 25 lakh. Next to that, cash is reduced, other assets you are reducing, equity you are reducing. What is this, sir? Listen carefully. This is not book value balance sheet. This is a fair value balance sheet, also called as a market value balance sheet. Listen carefully. In the world, there is no concept called as a liability. This is what I discussed in the first days of our class. Okay. When I said there is no liability, share is also not a liability. Always, whenever the assets values are growing, share price will grow. Assets value fall, share prices will fall. Whenever buyback is happening, cash will come down. How much cash is shrinked, that much the equity value also will drop. That's the equity here. Understood the point clearly or not, everyone? Everyone answer. Understood? Okay. Write down. Impact on EPS. Impact on EPS. See. Shall we? Okay. So now what will happen? 50,000 will go out. What will go out here? 50,000 will move out of the balance sheet. Previously it is normal. Now it is 50,000. So the earnings 3 lakh will be there before. Earnings are 3 lakh. Now the earnings are same 3 lakh, but the 3 lakh will be previously 3 lakh is shared by, okay, 1 lakh shares. Now 3 lakh is shared by, okay, 3 lakh is shared by, how many shares are bought back here? 50 paisa. 50 paisa means surplus cash 50,000. Surplus cash 50,000. Each share is traded at 25. 2,000 shares are bought back. Okay. Let us write down one by one. Number of shares bought back. Cash available divided by buyback price. Okay. Cash available 50,000. Nothing is said. We assume that buyback is made at market price. 50,000 divided by 25. 2,000 shares are bought back. Number of shares post buyback. 98,000. Earnings after tax. Previously 3 lakh earnings. Now also 3 lakh because 50,000 is from reserves. Three lakh divided by 98,000. 3.06 per share. So whenever company go for buyback, EPS will rise. Sir, everyone understood, completed up to here clearly? Everyone, complete up to here clearly? Next. Impact on MPS. Impact on MPS. Impact on MPS. Market value 25 lakhs. Market value 25 lakhs. Okay, that's a market value before the buyback. Market value before the buyback. How much? 24 lakh. Minus cash outflow 50,000. Assets reduction now automatically value of company also will come down. Previously 25 lakh shares are shared by 1 lakh. Now 24 lakh 50,000 will be shared by 98,000. Surprisingly, it stays at the same 25. So buyback, what is the impact? Market value will not change. Next. Impact on P by E. Rupees 25 by rupees 3. 25 by 3. 25. Market price is how much? 25. What is EPS? 3.06. Okay. 3.06. 25 divided by 3.06. 8.17. Sir, not rupees. 8.17 times. PE ratio reduced from 8.33 to 8.17. But it is same in both dividend as well as in buyback. 8.17 is common. Okay. That's it. This is the impact of buyback on various factors. One person asked the question, if the buyback is out of equity shares, buyback is out of reserves only, these rules are applicable. Fresh issue is not considered by finance because that is Companies Act of India. Finance is a worldwide global concept. Everywhere that concept might not be there. So always worldwide buyback concept means out of reserves a buyback concept. Understood? Arvind asked this question. Hopefully my answer reached you. Clear? With this, we completed entire concept also relating to the buyback. So now everyone, we are done with majority of the concepts also in this chapter. We completed question number 10 and question number 11. So we completed 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 27, 28, 29, 30. Everything is completed. The only thing that was pending in this area is rights issue and its impact on the wealth. Okay, keep the heading. Rights issue and its impact on wealth. Rights issue and its impact on wealth. Okay. Next session, we will continue this and complete rights issue and its impact on wealth. We'll continue in the next session. Okay. So thank you very much. Meet you in the next class and complete this chapter in the first 1.5 hour itself. Okay. Thank you.